Welcome back to Income Decoded, the channel where we break down real strategies for making real money online. No fluff, no fake gurus, just pure financial intelligence that you can actually use. Now I want you to think about something for a moment. Right now, while you are watching this video, your money is sitting in a bank account somewhere. Maybe a few $100s, maybe a few thousand, maybe more. And while it sits there, something is happening to it that almost nobody ever talks about. Something your bank has never explained to you. Something that makes them billions of dollars every year. Using your money and paying you almost nothing for the privilege. By the end of this video, you are going to understand exactly what your bank does with your money while you sleep, why they do it, how much they make from it, and most importantly, what you can do to make sure you are on the right side of that deal instead of the wrong one. Let us start with the most important thing nobody ever tells you about banking. When you deposit money in a bank, you are not storing it, you are lending it. Read that again. When you put money in a savings account, you are not putting it in a vault with your name on it. You are making a loan to the bank. The bank takes your money, it uses that money, and in exchange it promises to give it back to you when you ask for it and to pay you a small amount of interest while it holds it. That is the deal, that is the entire banking relationship. You are a creditor, the bank is a borrower, the bank is borrowing your money from you. And then it turns around and lends that same money to other people at a much higher rate. This is the business model, and once you understand it fully, you will never think about your savings account the same way again. Here is how it actually works. This is called fractional reserve banking, and it is the foundation of virtually every banking system in the world. When you deposit $1,000 into your savings account, the bank does not put that $1,000 in a safe. It keeps a small fraction of it available for withdrawals, historically around 10%. So $100 stays accessible. The remaining $900 gets deployed, lent out, put to work. But here is where it gets extraordinary. That $900 the bank lent out to someone else gets deposited back into another bank account, and that bank keeps $90 and lends out $810, and so on and so on. Your original $1,000 deposit multiplies through the system, creating loans, creating money, creating economic activity, all built on your initial deposit. This is not a secret, it is not a conspiracy, it is just how modern banking works, and it has been working this way for centuries. But here is what matters to you personally, the gap. Your bank pays you somewhere between 0.5 and 2% per year on your savings. That is the interest rate on your deposit. That is what they give you for letting them use your money. Now let us look at what they charge when they lend it out. Personal loans, 15 to 25% per year. Credit cards, 18 to 30% per year. Car loans, 7 to 12% per year. Home loans, 6 to 9% per year. Business loans, 8 to 15% per year. Do you see the gap? You get 1%. They charge 18%. They borrow from you at 1 and lend to others at 18. The difference is their profit, and it is built entirely using your money. Let me make this real with a simple number. You have $10,000 in a savings account earning 1% per year. After 1 year, your bank pays you $100. Thank you very much, here is your $100. But what did the bank do with your $10,000? A significant portion of it was lent out as personal loans at 18%. On $10,000 at 18%, that is $1,800 of interest income. The bank earned $1,800 using your money and gave you $100 of it. Their profit from your $10,000, approximately $1,700. And while this is happening, inflation is running at around 3%, which means the purchasing power of your $10,000 is shrinking by $300 per year, even while your balance slowly ticks up. The bank made $1,700 from your money. Your real purchasing power went down by approximately $200 after your interest income is factored in. You ended up poorer in real terms. The bank ended up richer from your money. Now I want to be clear about something. Is this legal? Yes, completely. Is it a scam? No. Is it immoral? Not inherently. Banks provide real services, they take risk. They manage the financial system. They enable lending that funds homes and businesses and economic growth. But here is the critical thing. You agreed to this deal when you opened your account. It was in the terms and conditions that nobody reads. and the deal is structured entirely in the bank's favor because most people do not know they can negotiate a better position. The question is not whether the bank should be doing this. The question is, why are you still accepting the worst possible terms? Let me explain the 4 things your bank actually does with your money while you sleep, because it is not just lending it out to individuals. First, consumer loans, personal loans, credit cards, buy now pay later products. Your deposits fund these products that charge borrowers 15 to 30% interest. This is the highest margin use of your deposit. Second, mortgages, home loans. Your deposits are pooled to fund the mortgages that other people use to buy homes. Lower interest rate than consumer loans but enormous volume. The interest income on a 30-year mortgage is staggering. Third, business loans. Companies borrow from banks to fund operations, expansion, equipment, payroll. Your deposit is part of that pool. Business loan interest rates vary widely but are typically well above what you are being paid. Fourth, financial instruments, government bonds, treasury securities, interbank lending. Banks invest in financial products that generate returns, safer, lower returns, but still well above what they pass on to you. All 4 of these activities are being done with your money, right now, while you sleep, while you work, while you watch this video. Now here is the part that changes what you should do about it. You have more options than most people realize, and none of them require you to do anything risky or complicated. Option 1, keep your emergency fund where it is but negotiate the rate. This is money you need quick access to, so it should stay in a savings account, but not all savings accounts are equal. Different banks offer dramatically different interest rates on the exact same product. High-yield savings accounts and online banks often pay 3 to 5 times more than traditional big banks. Same safety, same accessibility, significantly more interest. If you are not shopping around for your savings rate, you are leaving money on the table every single month. Option 2, short-term money goes into fixed deposits or certificates of deposit. Money you do not need for 6 months to 2 years earns significantly more when locked in for a fixed period. The bank pays you more because you are giving them more certainty about the deposit. The same money, meaningfully better return. Option 3, long-term money gets invested. This is the fundamental lesson from episode 4 of this channel. Money you will not need for 5 or more years should not be sitting in a savings account losing purchasing power to inflation. It should be working. Index funds, equity investments, assets that historically grow at 7 to 10% per year over the long term, not guaranteed. But when the alternative is losing purchasing power in a savings account, the risk-adjusted case for long-term investing is compelling. The goal is not to abandon the bank. The bank has a real function. It holds your emergency fund safely. It provides payment infrastructure. It is insured. These are genuine services worth paying for in the form of low interest. The goal is to understand the deal you are in and to make sure as little of your money as possible is sitting in the part of the deal that works entirely for the bank and barely at all for you. Here is the mental model that changes everything. Think of money as workers. Every rupee or dollar you have is a worker. When you put money in a low-interest savings account, you are sending your worker to work for the bank. They do the job, the bank gets most of the output, you get a small tip. When you put money in a higher yield account, you are getting a better share of what your worker produces. When you invest long-term money, you are putting your worker to work for yourself. The output comes back to you, compounding over time. Every rupee sitting in a low-interest account is a worker working for the bank. Not for you. Understanding this does not mean hatting banks. It means using them strategically rather than just defaulting into the worst possible arrangement because it was the easiest one to set up when you were 18. Now here is the practical action plan. Step 1. Find out what interest rate you are currently earning on your savings. Check your bank app right now. The number is somewhere in your account details. If it is under 2%, you are in the default low-rate arrangement. Step 2. Research high-yield savings accounts and online banks in your country. Compare rates. The best rates are often 3 to 5 times higher than the default. Moving your emergency fund to a higher yield account can add hundreds of dollars or rupees per year in interest at no additional risk. Step 3. Separate your money into 3 categories. money you need in the next 3 months, money you will need in 3 months to 2 years, money you will not need for 5 or more years. Each category belongs in a different type of account with a different rate of return. Default savings for Tier 1, fixed deposits or better yield accounts for Tier 2, investment accounts for Tier 3. Step 4. Never let a significant amount of money sit in a current account or checking account earning zero interest. This is the most expensive mistake most people make with their money. A current account pays nothing. Your bank takes it and lends it out at 15 to 20%. You get zero. Move everything except your transaction float into an interest-bearing account. Quick summary of everything we covered today. When you deposit money in a bank, you are lending it to them, not storing it. The bank takes your deposit and lends it out at rates between 7 and 30%. They pay you between 0.5 and 2%. The gap is their profit, built from your money. Your $10,000 earning 1% generates $100 for you per year. The bank earns approximately $1,700 per year from that same $10,000, from loans made using your deposit. This is legal, this is how modern banking works, and you agreed to the terms. The question is not whether the bank should do this. The question is how much of your money should be working for you instead. Emergency fund, high-yield savings account, not the default big bank rate. Short-term money, fixed deposits or better rate accounts. Long-term money, invested in assets that beat inflation over time. Not complicated, not risky, just understanding the deal you are in and choosing the best version of it available to you. Drop a comment below. Did you know your bank was doing this with your money? What interest rate are you currently earning on your savings? Let us see the numbers. I read every single comment and I reply to as many as I can. If this video gave you even one moment of awareness, please hit the like button right now. It takes 2 seconds and it genuinely helps this video reach more people who need to hear this. And if you are not subscribed yet, what are you waiting for? Hit that red subscribe button and turn on the bell. Every single week on Income Decoded, I drop new videos breaking down real money strategies and real financial intelligence with real numbers. There is a free Make Your Money Work Harder guide linked in the description below. It gives you the exact steps to find the best savings rates in your country, the fixed deposit comparison framework, and the 3-tier money system worksheet. Download it completely free, no catch. I will see you in the next video. Stay focused, stay consistent, and remember, every rupee and dollar you leave in a low-interest account is one that works for the bank, not for you. Let us